Hey everyone, hope you're doing well. Just wanted to make a video about something that I've been augmenting the Hedgeye process with, and that's this site here, which is Squeeze Metrics. I mentioned it a few weeks ago if people took part in one of the notebook reviews on Twitter Spaces. Obviously you can't share screens or anything on there, so it probably just, because I had all these things that you're going to see in a minute in my head, it probably just sounded like a big mess of gobbledygook, but I'm going to start to try and explain at least how I'm beginning to interpret what the data is and how I use it to think about entries specifically. So on this chart here, so there is a paid subscription, which is, at least for me, it's quite substantial. So I just use the free bit at the moment. So yeah, it's based on the S&P 500, the SPX index. So this green line here is the S&P 500 price. Then this secondary line here in yellow is the gamma exposure level. Okay, now I'm just starting to learn. I've asked a few questions in the arena if you've seen about options and things like that. So I'm just starting to understand what some of these things are. If I understand it correctly, and hopefully people will correct me if I'm wrong, you take the total of all the puts and all the calls that are in place, or all the strikes, sorry, so all the strikes that have an existing contract against them. So you take the gamma position of all the puts, multiply it by each contract's open interest. So if there's 1,000 contracts at X strike, then you multiply it by 1,000, and you do that for all the puts. Then you do it for all the calls. And I'm not sure if you multiply it by the contract price. I'm not quite getting, no, that's not quite right, but the site explains it all. I hope that's roughly how it is. But basically, this is if you've seen anybody talk on podcasts or on people sharing stuff on Twitter, this is kind of this whole gamma flip type thing. It's where does the gamma exposure of the dealers flip from positive to negative? Okay. So we've just had on the 6th, is that for the 6th? Yep, the 6th of January. So the gamma exposure for the SPX was just over $2 billion. And then you can see, based on the chart of the S&P 500 here, when it gets to these negative prices, the price tends to bounce. And at least, but it's sometimes, like here, this was the 20th of December, it bounced and shot higher, just had a huge move higher. And then, there's been other periods, like here in the start of December, you kind of had this bounce and a lull, and then a follow through. So so go and check this website out. I'm hopefully going to try and explain how I use it in the next slide. So so all the data is available. You can download it, going all the way back to, I think, 2011. On these charts, I just have going back to the end of 2020. That's because of this column here, which is iVol Premium, that comes from the Hedgeye macro show deck for the S&P 500. I've only managed to go back that far because I've had to go back through each chart deck day by day to get the prices out of it. Okay, so this is a normal chart that people might see on some of my dashboards, which is the price of the S&P 500 in this case against volume versus 1 month average. Okay, this chart here, actually, if I just remove that for a moment. There you go. So this is a chart that people will recognize from some of my dashboards. Again, this is the price versus the 1 month high. okay? So these are pullbacks from 1 month highs, so at this point, and the spreadsheet's crashed, great. Come on. There you go. Obviously, as soon as I started interacting with the chart, this spreadsheet crashed. Okay, so at this point, this was the beginning of October. So at this point, the 4th of October, the S&P 500 was down 5% from the last 1 month high. Okay. Now that's obviously a moving target, because as each day, as we move to the 5th of October, if the 1 month high was on the 4th of September, so 30 days ago, that 1 month high is now gone out of the look back. So this is a kind of moving target, okay? And this is where we are today as of close on Friday. So we're down 2.5% from the last high, all right? Now if I overlay this gamma exposure again, this one, yep. So all I've done here is I've taken the gamma exposure and just sorted it into levels. So if it's less than 0, it's -1. Then 0 is up to 5 billion, 10 billion, 15 billion, 20 billion, and 25 billion, okay? That's what these levels are. But if you see, there's quite a strong correlation here between when gamma exposure goes negative, it tends to indicate a bottom. Okay, you can see it definitely here at the end of September into October. Here again obviously as soon as I started interacting with the charts, Google Sheets decided to crash. So yeah, so these are the charts that I've been showing, which is the distance from drawdown from 1 month highs. And this is an overlay of the gamma exposure level. So as you can see, the lows, let's take the most recent one, significant one rather, that's at the start of December, coincided with a negative gamma exposure, okay? Then you had another low on the 20th, but the gamma didn't actually go negative at that point. But you can see here, the end of September, the beginning of October came with negative levels. Significant one here in May. This was March, again, negative gamma exposure, indicated a bottom. The bottom here, sharp move in gamma exposure, then it went negative again, so you kind of had this relief bounce and then a move lower. Same here in 20th, you had the 20th of September, gamma exposure went negative, you had a relief bounce, and it then fell again. So yeah, part of the Squeeze Metrics website shows some of the other charts that he shared, not on the website, you can do it yourself once you have the data. Shows the 30-day return. So if we take this period in September, so if we take the 30th of September, you had -5 billion of gamma exposure. The forward 30-day return, so 30 days from there, so that would have been obviously the end of October, the S&P 500 was 7.5% higher, okay? From that point. and higher forward 30 days returns coincide with these negative gamma exposure levels. Now we'll get to March 2020, okay, but negative gamma exposure coincides with high or increased 30-day forward return numbers for the S&P 500, okay? Now this is the kind of, not Hedgeye specific, this is iVol Premium, okay? I've seen conflicting things of whether people use this or not. Now, obviously, Keith shares it as part of the macro show chart deck. Now, what's been different, at least in the since the end of September, is that these negative gamma periods came on the back of increase in implied volatility premium. Okay, an implied volatility premium is when the market is pricing volatility in 30 days time to be higher than it is now. So it's the implied versus realized. Okay. So this is periods where people are saying volatility is going to be higher in the next 30 days. So I'm buying whatever, either I'm buying the VIX or buying puts. Okay. Which where you have this kind of gamma squeeze period. Okay, where the positive gamma squeezes the market higher. That's very different to today, where this negative gamma period has come off the back of negative implied volatility premium, meaning people thought that volatility was going to be lower. Now, there's been a few people on the arena, and I've said it previously in the past during notebook reviews. This is the part where it's never just one number. This is the part where, yes, I'm making these videos, and there's been calls for there to be better videos and explainers for these things. Not for everything, but this is a time where a video that was made in these times trying to explain something would become stale now. So if someone come along now and watched that video, it would be completely wrong to what they were seeing in the market. And this is what I mean by these numbers. Although this implied volatility premium is one number on a chart, it's how that number is constructed which is most important. Okay, and this is something like I'm in no way saying that I understand exactly what it means. But there's everything that goes into this that you need. It's the ratio. Yeah, okay. People are saying that volatility will be lower. Excuse me. Volatility will be lower in 30 days time. But you have to think about how are you pricing that, because from Hedgeye, they're pricing it using put implied volatility. But the put to call ratio has been skewed differently over the last 6 to 8 weeks. So this is what I mean by it's never just one number. Okay. You have to understand, or at least have an understanding that the number will change and why it's changing. This was the expected value thing that I've talked about in the past. The expected value is one number on a chart, but it takes 6 numbers to generate that one number. And that's the same case here. It's, yes, okay, coming into the end of November, the implied volatility premium was 108%. But how do you get that number? How do you get that 108%? Because the values that go into getting 108% here are different to the values that get the minus 19 here today or on Friday. Okay? So it's never just one number. So how am I using this? Okay. If you saw any of my tweets over the last couple of days talking specifically about XLRE, I said if you have a core position, you have time to kind of sit and wait because you may have been selling some as it was going up and it had a one-day pullback. Don't pile in. Why? Well, because this is why. If I can wait, if I can use this 30-day chart from 1 month, price from 1 month high, and wait for these negative gamma periods, it's a higher probability chance to buy anything that you want. Now, this is just for the S&P 500. There's completely different values for XLRE and whatever else. But it's a guideline. This is a free guideline, okay? It's something that you can use, another string in the bow to help you make decisions. That's what I always talk about. It's always making decisions. What decision are you making today? Do you know why you're making it? And if it goes right or wrong, can you say, I got that right because I'm super awesome, or I got that wrong, but I made these 5 decisions and I know why I made them. It's just the trade didn't work. There's a big difference, okay? Now, it's not that it's not perfect, but like I said, you have these, the gamma exposure goes positive, you have these kind of bounces, and then it can go against you. This is where you need to be. It's not foolproof. It's not just every time it goes negative, I'm going to buy. Yes, maybe buy, but this is where perhaps in real-time alerts for Hedgeye subscribers, real-time alerts can be very quick. It's like you buy then, you buy now, and then either first thing the following morning or a couple of hours later, it's closed out. The opportunity has changed, okay? So if we take, for instance, if we go to March 2020, so let's look at March of 2020. The blue line here again is the drawdown from the last 1 month high. Excuse me. The red line is the negative gamma exposure. And you can clearly see the gamma exposure was negative. You have this long period from the end of February going through to the 3rd of April. Okay. Now, if we look in this column here, the 30-day forward return was, so from the 30 days from the 24th of February was minus 18, big minus numbers. You had a bounce. Okay. We had a bounce as we were moving forward, but the number remained negative. The number remained negative, so as on its own, it became less of an indicator of forward performance, okay? Again, you had the long period of negative gamma exposure. We got this big jump higher, and then again it went negative. So you had this bear market bounce, and then we carried on and on and on, all the way down to obviously the 23rd of March there. Now this is where you combine it with volume. It's not labeled here, sorry. But this is the 1-day volume against the 30-day average. So it's what you'll find in my other charts, in the charts that are on the dashboard, okay? Now, these are big for a big index, for the S&P 500. You know, this isn't a random small cap stock that any one big player coming in and buying or selling at any one time will have a huge impact on the volume. This was, you know, this is the largest index on the planet, the S&P 500. So when you see these big volume numbers, so yes, okay, we've found that a negative gamma reading has a strong correlation to higher 30-day forward returns. But when it's come in on the fact, okay, like here on the 28th of February, nearly 3.5 times on one day, nearly 3.5 times the volume of the last 30 days for an index as big as the S&P 500. So this is where you have to tie in other things. It's never just one thing. It's never just implied volatility premium. It's never just the quad changing. It's never just negative gamma exposure. You have to combine all of them. And at any given time, this is what I made on one of my last posts on the arena. At any given time, the gamma exposure may be the single most important factor you need to look at. And volume isn't as important. But then at certain periods of time, yes, you have this negative gamma that we've been talking about, but then volume is the single most important thing you need to look at. How many people are transacting and at what levels are they transacting? Why are they making the decisions that they're making? This is, and it's, again, it's never just one number. It's all the numbers. That's why it's hard. You have to look at all the things and understand, is it going on in the S&P 500 on its own? Obviously at that period, no, it wasn't. And this is what you have to look at. Are bank stocks going up? Yes, bank stocks are going up. Well, actually, so is the FTSE 100. And the FTSE 100 has, I don't know, 25% weight into bank stocks. Oh, sorry, not the S&P 500. The FTSE 100 has a 25% position size in. Well, this is what Keith always talks about as similar sets. Okay, so you have to combine all the things. This is why it's hard. You have to look at all the things all together and put them together and see which ones matter at which time. Okay, so this wasn't a quick video. As ever, I start out making a quick video and it turns into 20 minutes. If you've made it this far, these are things that I'm going to be building on, over the next few weeks, and hopefully I'll make videos as I'm going along and as I'm learning new bits. There is another volume metric I want to start using, which also comes from that Squeeze Metrics website, which is the dark pool index. He references to it as the DIX. But it's looking at not just the nominal volume that you might see on a chart like this. It is, if I go to the sectors, so if we take the SPY, so that's the nominal volume that you'll see. Okay, but this is the volume that's taking place off exchange, if I understand that correctly. And again, a ratio. What is the ratio of this off exchange volume in relation to the on exchange volume? And that will give you an indication of who and by how much of the daily volume are people buying. So that's going to be another video, and there'll be plenty more to come as I probably dig myself into holes and rabbit holes and get things completely wrong. But if I figure out I've made something or done something wrong, I'll make a video and I'll show you at least how I've figured out how I got it wrong. So yeah, hope that was helpful. Hopefully that was helpful. And yeah, let me know, post comments, whatever. What have I got wrong? How can I get better? Tell me whether this is even interesting or not. Is this way too in depth and not very interesting? Just let me know. Cheers, guys.